Hey guys, welcome back. In this video, let's talk about how to make thousands of dollars with options trading in just 2 trading days with a very small sum of capital. Now, I've made thousands of dollars in just 2 trading days during the market crash, and this is how I did it. But first, I have to explain my thinking framework, and I will leverage on my friend's post, and I'll share it with you today on what is the situation that has happened on 2nd August during Friday. Now, my friend Bunty said, and I quote, "For those who are wondering about the unwinding of the Japanese yen carry trade, is that many traders use carry trades. And carry trade involves borrowing Japanese yen at a low interest rate, converting it to US dollar and other high yielding assets, and profiting from that spread. So basically, they borrow Japanese yen at a low interest rate, they take the cheap Japanese yen, they take their money, invest into US stocks because of the higher yielding aspect, and because of the dirt cheap interest rate, they are able to arbitrage the difference between a high yielding asset and a low interest rate loan. So the problem here is, these USD assets eventually need to be converted back to JPY, or Japanese yen, to close the trade. So when the Bank of Japan hikes the interest rate, not just Japanese yen strengthen, but the interest on the loan that they have to pay increases as well. So as a result, these traders lose out on both the interest rate difference and the FX movement. So imagine a scenario where a few months ago, 1 SGD, right, can change for 1 SGD for 118 Japanese yen. So when this happens, Japanese yen strengthen, let's say 1 Singapore dollar can change for 116 Japanese yen, and this happens because the Japanese central bank increased their interest rate and JPY strengthened. Imagine you're one of these carry traders. You're essentially borrowing 1 SGD to 118 JPY. Now when you have to return, you have to return them at 116 JPY, right? Means Japanese yen strengthen, you have to pay more on your loan. So a lot of these traders have to close their trade, and as they close their trade, the demand for Japanese yen strengthen, and this causes a domino effect, right? So let's say, for example, 1 SGD used to change for 118 Japanese yen, then it falls to 116, 114, 112, 110, and subsequently it falls to 109. So a lot of these traders got margin called, and this has a spillover effect, and hence it caused a sharp movement in the market price over the short term. And because personally for me, I'm quite well versed in the Japanese yen market, because I myself buy a lot of physical Japanese yen, right, to do my Japanese biscuit business in Japan. I've bought up to $1 million in Japanese yen physical cash to facilitate my trades, and I cash it out in US dollars, cash it out in Singapore dollars, on all that, and hence I'm quite well versed in Japanese yen. So knowing all this, right, I understand what is wrong with the market, I understand options, what can I do about this? So at Friday night, on the last hour of the trading session for the week, I thought it would be a too good an opportunity to miss, to actually execute a trade to short the market. Because based on my experience, I've been through these kind of scenarios before, where there is a sharp momentum, and people that wants to short the market, they will short the market. And there is a huge momentum, right? It's a seller's market, and people that want to make profit in the short selling point of view, they are making money through shorting. And the more people understand this, right, they understand the price movement, they understand momentum, they understand the sentiments have changed, more will join in, there will be a sharp decline. So knowing this will happen, I understand there is a lot of momentum build up for this kind of domino effect. I executed what I call a buy put option, right? Basically what a buy put option is that a buy put option is when I am bearish on the stock or the market. I use lesser amount of money to have the right to sell bigger exposure of shares. It's basically like the Michael Burry style, right? The cons of it is that the down payment will become zero if I'm wrong on the price and the date, right? Because I'm only paying a small amount of money to get bigger exposure of shares. Now the pros is that there is theoretically unlimited upside and limited downside. In that case, my down payment, right, if I'm wrong on the set price and the date, I might get the down payment down to zero. So knowing this Japanese yen spillover effect, right, where people are going to sell away their US dollar asset, or they're going to sell away their global holdings, and they are going to move back their money to Japanese yen. So there's going to be a huge fall in the indexes, right? So you can say there are a few index, like S&P 500, the Nasdaq 100. I chose Nasdaq 100 as the indexes to short because Nasdaq 100 is comprises of 60% technology companies. Right, technology companies are more volatile, right? They gain faster, they lose faster, and there will be a momentum going forward, right? So in my case, I chose QQQM put. I bought put option on it. So in my case, I did not even put on much capital ahead. I just put $5.75 times 100 shares, because one lot is 100 shares. I paid $5.75 US dollars to get the opportunity to short QQQM. I just thought it's such a good opportunity to do it, so why not? So on Friday night, I executed this trade. Friday night, the last hour, I paid $5.75 US dollars to execute a buy put option to have the right but not the obligation to sell QQQM put, right, the Nasdaq 100. And on the next trading day over the weekend, when Monday it opens, I just closed the trade, and I managed to sell it for 1190 US dollars or 1190 per share, right? So within this trade, I managed to bag 635 US dollar just from one trading day to the next over the weekends. And also at Friday night, 2nd August, in the last hour, I thought, what can I do? Now that I know that my stock holding, my portfolio will fall, right? I know that the chances highly likely is that my stock will fall and it is unlikely that it will go up. So knowing this, I have shares, but I do not want to use more cash to buy more put option. So I decided to pack 100 of my Tesla stocks. So when I pack 100 of my Tesla shares, I'm guaranteeing to sell 100 Tesla shares. And I chose a strike price of 210, which is the current trading price. So it's at the money. So I sell a call option at a strike price 210, 1 month forward. In that case, August 30th. And for me to guarantee to sell 100 Tesla shares, I can't just guarantee without taking on a form of incentive. So in that case, for guaranteeing to sell 100 Tesla shares, I'm rewarded or incentivized or paid a premium of $11.77. Now this $11.77 is a premium I take for bearing this risk. And my worst case scenario is, if Tesla shoots above $210, my shares will be called away, right? I'll be forced to sell my shares that I'm already holding. But because I receive the premiums for bearing this risk, I bear this risk, I receive the premium. This premium can be added to my strike price, and this can be a safety cushion and increase what we call the break-even price. So if you add the premium up, $11.77 to my strike price of 210 US dollars, this will become $221.77, and this will be my new break-even price. So should Tesla shoot above $221.77, I will start losing potential profit that I would have lost had I just choose to hold on to my shares instead of selling a call option. So this was the risk I was willing to take, right? I was willing to pack 100 of my Tesla shares to sell a call option because I foresee a downward movement, right? Tesla is not going to go up, it's going to go down, and that premium I'll receive for free. It's just free money for me. In that case, I thought it is highly probable that I'll receive $11.77 times 100 shares, which is 1177 US dollar for free. And Monday came and I was right about this, right? The Tesla call made money. The QQM buy put option made money. And in this one trading day, I was able to make $1,238 minus trading expense. It will be 1,230 SGD, or in US dollar, 935 US dollar over one trading day to a next trading day over the weekend. So I want to specify the buy put option for QQQM, right? The Nasdaq 100. I only paid 575 US dollar to buy the put option. That was my cost of capital. I was able to make back more than 100%. I get back 1190 US dollars over the span of one day. This is the reason why I want to do this video today, because with options, you are able to make money from all different sides of the market, be it a sideways market, a ranging market, a trending market, a bullish market, a bearish market, a sideways market. You can make money from all of them. And this is why I want to share with you. And I think in this video is extremely relevant because my cost of capital, right? My cost of capital, if you were to think about it, is only 575 US dollar, which many of you can afford. And I use my existing Tesla holding, my Tesla shares, as collateral. So it is already stocks that I am investing. There was no cash outlay. I did not take out much cash to do this trade. I only took out my shares and I took out 575 US dollar. I was able to make thousands of dollars over one trading day to the next trading day. And this is how powerful options can be, right? And I think this is very relevant for you guys because in the past I've been managing high six-figure portfolio and I may not be very efficient in the way I use my capital. And it is not very achievable for most of you because not many people will have high six figures in their mid-20s or 30s, right? So I don't think it's relevant in whatever I share, but it is getting more and more relevant as I think in terms of your context. So specifically, other than learning how to buy put option and sell call option, what I really want to talk about today is the cost of capital, right? When you are doing options or when you're doing any trade, you have to be efficient in how you use your capital, right? In my case, I only use 575 US dollar, I get back 1190 US dollar. That is more than 120% upside. I think if you were to do it in percentage, it's about 110 to 120% upside over the span of one trading day. And that is quite insane, which many of you can actually replicate if you see the chance, so long as you understand and you study options. And over the years, since 2021, I've been documenting my options trade since 2021 until now, right? And all my trading experience from 10 years and 5 years of trading options, I've documented it into my trading notes. So if you guys want to learn and show interest in what I do, and you want to support me, right? No obligation, you can just go to my website. I will just put it under my Whiskey website. There'll be a hidden page where you can purchase my trading notes that I've documented it down for years. You can buy it and let's make it fun. The first 2% that buys it get a huge discount. So the trading note is designed for you to understand everything about options and what I do. In the training notes, I will go through the basics so you understand everything, all the 4 sides of options. You understand delta, implied volatility, theta, the different options jargon, right? And then I will go on to the advanced options, where I teach you my style of approaching options, right? How I make use of different things like technical analysis, sentimental analysis, fundamental analysis, right? How to set up your own trade plan, what is low risk entry, then the different kind of ideal scenario, in which I documented it down into a trading note for you guys to see if you want to, right? I've been doing this for years and I have not monetized much. So if you want to support me, just go ahead. No obligation again. I'll probably increase the price for this. So the first 2% that gets it will get it at a very special discounted price. Okay, with that, I hope I help you out in your options trading. If you'd like to see more, just comment on how I can help you. If not, thank you and I'll see you next week.